Let me cut straight to the point. You don't need a six-figure bank account to start investing. You don't need a finance degree or a fancy Wall Street broker. What if I told you you can buy a tiny slice of huge companies with just $5? Over years, you can watch that small slice grow right along with them. Most people have it all wrong. They think investing is only for the rich who drive fancy cars and live in big houses. Or they think it's only for financial experts who spend all day staring at confusing graphs. But that's just a myth that keeps millions of people from building long-term wealth. The truth is, right now, millions of regular Americans are starting investing with $10, $20, even just $5. They don't have special connections. They just know simple basics no one ever bothered to teach you. This video will break down everything a total beginner needs to know. No jargon, no confusing formulas. Hey everyone, welcome back to the channel. If you want to learn how money works, start investing, and build long-term wealth, you're in the right place. Today, I'm breaking down the stock market for complete beginners. We're skipping all the confusing jargon and fancy terms that need a finance degree. We'll start with what the stock market actually is. Plain and simple, no fluff. Next, I'll walk you through how even total beginners can put their first dollar into the market. You don't need thousands to start. I'll cover what platforms work, what accounts you need, and how to pick your very first investment. Then, we'll go through the 3 most common mistakes new investors make that cost them thousands over time. These are totally avoidable once you know what to look for. By the end, you'll have a clear step-by-step plan to start today. No unanswered questions. Keep this simple. The stock market is where people buy and sell company shares. You don't need a fancy finance degree to understand how it works. When you buy a stock, you aren't just buying a random piece of paper or a number on a screen. You are buying a small piece of actual ownership in that company. Even a single share makes you a partial owner. If the company grows, your investment can grow right along with it. Let's break this down with a simple example. A bakery wants to expand, sells 100 shares. You buy 1 share for $10, giving you 1% ownership of the whole bakery. The bakery uses $1,000 to open a second location. A year later, it sells twice as many cakes. The bakery is now worth $2,000. Your share is worth $20. You just doubled your money. When more investors want shares of a growing company, demand goes up and prices rise. That's why people invest. They put money into growing companies to grow their own wealth. Let me start with a question. Have you ever called stock investing just fancy gambling? You're not alone. Millions of people believe this and stay completely away from the market. But most people miss this critical point. Long-term investing is nothing like random casino betting. Let me break this difference down clearly. Gambling relies almost entirely on luck. Long-term investing is built on 4 concrete pillars, none of which are luck. First, business growth. You own part of a real business, and its growing profits make your share more valuable. Second, time lets compound interest turn small, steady gains into massive wealth. Third, research lets you make informed choices instead of blind guesses. Fourth, patience means holding solid businesses through chaos and waiting years for results. Let's be clear, investing is not risk-free. Prices move daily, markets can crash, bad companies can fail. But risk is not a bug, it is part of the game. Gambling is random chance with no control. Investing is intentional work. They are not the same at all. Most new investors quit before they even start. They believe you need 6-figure savings and a finance degree to begin. That doesn't have to be true. First, learn the basics without risking real money. Use free beginner online courses to understand how stocks, bonds, and funds work. Open a free demo account with fake money and practice for 3 months. When you see steady growth, you're ready to move forward. Next, open a low-fee brokerage account. Most top brokers offer 0 commission trades, and many let you start with $0. Just fill out your info, link your bank, and get approved in a day. Finally, start small. You don't need thousands of dollars to begin. Many start with just $50 or $100 each month. Invest that fixed amount consistently, no matter what the market does. Skip the risky meme stock bets that promise overnight riches. Focus on learning and building good habits. Over 10 or more years, those small, consistent monthly investments will add up far faster than any risky get-rich-quick bet ever could. Anyone can start today. If you're new to investing, watch out for these 3 common mistakes. These mistakes can sink your portfolio before you even get started. First mistake, trying to get rich overnight. Social media creators show huge, quick returns, but fast money almost always comes with extreme unacknowledged risk. Most end with beginners losing half their savings. Second mistake, chasing the latest hype. Right now, everyone talks about the same 3 hot assets, but hype almost always peaks right before prices crash. New buyers are left holding assets that lose 80% of their value. Third, and most dangerous, investing money you need in the next 6 months. You might empty your emergency fund to chase bigger growth, but markets never move straight up. If you need to sell during a dip to cover a surprise bill, you lock in a permanent loss. This creates a permanent loss you can't reverse. Good investing is built for the long haul. Keep short-term cash needs separate. Avoid these 3 traps, and you will skip 90% of the mistakes that trip up new investors. Frank sits at his kitchen table, staring at 2 very different stock portfolios. One is down 32% in 3 months. The other, slow and steady, is up 18% in 5 years. This is one of investing's most overlooked lessons. Time matters. A decade ago, Frank split his savings. 70% went to a hyped new startup that promised 10x quick returns. The rest went to a boring, low-fee S&P 500 index fund. At first, the startup boomed. Frank bragged at every dinner. Then a failed regulatory test crashed the stock, and the company went bankrupt. He lost every dollar he invested there. The boring index fund had no viral wins to brag about. Some months it fell, some months it barely moved. Frank didn't check it every day. He never pulled money out for hot new crypto or meme stock trends. He just set up automatic contributions and left it alone. Today, that small, steady investment is worth 3 times his total contributions. It pays his daughter's college tuition and covers most of his retirement. Many new investors get this wrong. They chase quick wins instead of consistent long-term growth. The slow path isn't exciting for social media, but it's the slow, steady path that actually gets you to the finish line. If you're new to investing, you've likely seen dozens of get-rich-quick tricks online. Those exciting promises of fast gains almost always leave you with an empty bank account. Sustainable investing doesn't work that way. The best move as a beginner is to go step by step. Before you invest any dollar, learn the fundamentals. How shares work, what moves prices, and how trading orders function. Read trusted books, take free reputable courses, and practice with a paper trading account first. Paper trading lets you test strategies without real risk, so you can see how your choices play out. Next, stay patient. You won't build a 6-figure portfolio in 6 months. Even top investors only average 7 to 10% annual returns over decades. Avoid chasing hot social media tips. Most importantly, don't make emotional decisions. Don't panic sell in crashes or get greedy at all-time highs. If this straightforward breakdown of investing basics helped you, hit the like button, subscribe for no-fluff investing tips every week, and I'll see you in the next video.